Hello, my name is Brenton Harrison with Ultra Borrowers Academy, an online course where we help people with a mountain of student debt take back control of their loan future and the rest of their finances. We're here today to do a quick video on the difference between subsidized student loans and unsubsidized student loans. So if you've gone through multiple levels of schooling, undergraduate and graduate training, you probably have faced the difference between subsidized loans and unsubsidized loans in the past and not quite understood what one means from the other and how it impacts your payment and the interest that's due on your student loans. So hopefully today's video will give you a little help in that regard. And we're going to get started by first explaining the difference between the two types of debt. Subsidized debt is debt where the interest that's growing or accruing on your loans is subsidized or paid by the federal government on your behalf as long as you're in a period of deferment. Now, a period of deferment may mean something like being in school. If you're a full-time student, then you can have your student loan payments deferred, but it also could mean a period after schooling where you're unable to make payments and you're in a period that qualifies for deferment. And with subsidized student loans, in any of those sessions, you will see the interest that's accruing paid on your behalf by the federal government. It doesn't mean that interest doesn't exist. It just means that it's not your problem. It's not something that you're responsible for. So if you're looking at this example, if we have a $20,000 loan at 5% interest, well, it really doesn't matter what's sitting in that interest category because as long as you're in the period of deferment, the government's going to cover whatever would have gone in that section on your behalf. This is something that you typically see for undergraduate loans, where these loans that you take out for your undergraduate schooling are subsidized on behalf of the federal government. Now, unsubsidized loans work very differently because with unsubsidized loans, the interest that accrues is your responsibility even while you're in school. And this is something that you typically see for graduate schooling, be it medical school, MBA programs, master's degrees, PhDs, where you take out unsubsidized loans, and you might have taken out $100,000, but the interest that's accruing on those loans accrues and is your responsibility for after graduation. We have an example here of $150,000 of loans at 5% interest, and that would produce $7,500 of interest, and this is just a straight line calculation. But you can see from 1 year to the second year to the third year, that $7,500 of interest is going to look on your statement like a separate loan category where you have your loan balance in one, your interest in another, and whatever's growing in that category is going to be your responsibility after you graduate. That's the basic difference between a subsidized loan and an unsubsidized loan. Now, there are a number of reasons that you want to keep those separate in your mind when it comes to things like consolidating your loans and repaying your loans. Because what consolidating your loans is, it's a process where you take all of those disparate loans, all the loans that you take out in each semester of schooling, and you consolidate them into one new loan. Now, there are a number of reasons that you would do this, be it in terms of a payment plan that you want to be eligible for or a forgiveness program that you'd like to be eligible for. But when it comes to subsidized loans and unsubsidized loans, you can't consolidate them together with the federal government. Now, I put federal government in parentheses there because if you were to say take a federal student loan that's subsidized and a federal unsubsidized loan and refinance it with a private lender, then you actually can combine the two. But if you're keeping your loans with the federal government and you're consolidating loans, you will still see two separate loans. They will take all of the subsidized loans that you have and they'll add it into what's called a direct subsidized consolidation loan. And they'll take all of the unsubsidized loans and they'll do the same. You'll have a direct consolidated unsubsidized loan with the federal government. And the reason they keep these things separate really breaks down into two categories. One of them is the repayment period for these student loans. And then the second is the interest subsidy that may be offered based on the payment program for which you are choosing. Let's go into the repayment period to explain why it's important that the government keeps these two separate. We've covered income-driven plans many times, so we won't go through the whole spiel when it comes to income-driven plans, but just understand that there's a possibility under these plans where the amount that you pay over the course of either 20 or 25 years, depending on your payment plan, is not enough to actually pay the loan off in full. So if you're aiming to have your loans forgiven, Depending on the payment program you choose, you could have to pay for 20 years before your loans are forgiven, or you could have to pay for 25 years, depending on your payment program. And of all the plans that we've discussed, there's one in particular called the Revised Pay-As-You-Earn Plan, or the REPAY plan, that separates how long you pay your loans based on whether they are subsidized loans or unsubsidized loans. Under REPAY, for subsidized loans, you only have to pay them for 20 years. I say only in jest. But after 20 years of payments, if you have any remaining balances, that amount will be forgiven. You'll have to pay taxes on that amount as if you earned it in the year that it was forgiven. But subsidized loans, after 20 years of payments, you no longer have to pay that responsibility. With unsubsidized loans, you have to pay a bit longer. If you have unsubsidized loans under the Revised Pay-As-You-Earn plan, the remaining balances will be forgiven after 25 years of payments as compared to 20 that's offered by the subsidized loans. This is the difference in the repayment period between the two forms of debt. Interest subsidies are another area where they differ. What an interest subsidy is a tool that the government uses to pay some of the excess interest that's growing on your loans. So we're building off of our knowledge base where we said that a subsidized loan is when the government pays interest on your behalf. Well, a subsidy is the same thing. A subsidy is when someone pays something for you on your behalf. And in regards to subsidized versus unsubsidized loans and how you repay them, what they consider an interest subsidy is basically a circumstance where you're paying an amount towards your loans that's not even covering the minimum interest that's growing each year. And it may seem like the government would love that. It may seem like they would love to watch your loan balance increase. But remember, they have given you the option of having these loans forgiven after a period of time. So if they don't do something to help manage how much your loans are increasing, they're actually decreasing the odds that they get all their money back. So they offer this assistance through what's called a subsidy to cover some of the interest that your payment doesn't carry. An example here is, let's say we have $300,000 of loans growing at 5%. Well, 5% on $300,000 is $15,000. That means you'd have to pay $1,250 a month in interest this year to still owe the same amount next year. And this is something that a lot of ultra borrowers deal with, where it seems like they can't pay enough to actually make their balance decrease. That's because of how much interest is growing on those loans. Well, let's say that under an income-driven plan, $15,000 of interest is accruing, but you're only, under the calculations of that program, required to pay $5,000 in annual payments. Well, $15,000 in interest minus $5,000 in payments equals $10,000 of excess interest, just interest that your loan payment didn't cover. This is where the subsidy steps in. What a subsidy is, for example, is when they cover some of that excess interest. And in this example, we're going to say that the subsidy is 50%. So if you take that $10,000 of excess interest that your payment didn't cover, a 50% subsidy would mean that the government would write a check for half of that excess interest. And instead of $10,000 being added in accrued interest, only $5,000 would be added. Now, how does this tie all back into the Revised Pay-As-You-Earn plan and subsidized versus unsubsidized loans? Well, with the Revised Pay-As-You-Earn plan, the subsidy also differs between subsidized and unsubsidized loans. If you have subsidized loans under the Revised Pay-As-You-Earn plan, then in the first 3 years of your repayment, 100% of the excess interest will be covered through subsidies. And in year 4 through 20, 50% of the excess interest will be covered. If you have unsubsidized loans, it's a bit different. But instead of splitting the two, 100% some years, 50% in the other years, 50% of the excess interest will be covered through a subsidy under Revised Pay-As-You-Earn in every year of payment. These are just some of the ways that subsidized loans differ from unsubsidized loans. I hope all this was helpful to you. There are a number of other reasons that can make a subsidized loan different from a subsidized, but in terms of the things that you see on a daily basis, these are some of the key principles that we want you to take beyond this session. I hope this was useful to you. If you want to check out more about our course, you can go to ultraborrowers.com. We can help you manage that student loan debt and put you in a better path financially. I look forward to seeing you guys in the next video. Have a good one.